Hi everyone, my name is Mitch Comben. For those that don't know, I work with Pepperstone's high value clients here, and lately I've fielded an increasing amount of questions regarding the US debt ceiling and the impact it may have on financial markets. As a result, I thought it would only be suitable to bring in our head of research, Chris Weston, to dissect the topic and answer these growing questions for you. So welcome, Chris.
Thank you, Mitch.
Starting at the beginning, what is the debt ceiling and why should it matter for traders?
So in the beginning, well, in 1917, they brought this rule in, and over the years, really what it does is it offers fiscal restraint so the government doesn't overspend. Yeah, the US continuously runs blowing out deficits, which they need to fund, and that increases public debt, effectively, or government debt, should we say. And so they just want to keep some sort of checks and balance on it. So they created the debt limit. Currently, that stands the ceiling at $31.38 trillion. So they hit that on the 19th of January. And since that point, they've been constrained from issuing more debt. They've been using what they call extraordinary measures. And those extraordinary measures are under pressure at the moment, and we should probably see them run down into June. At that point, it becomes a little bit more of a problem because we've got obviously a lot of outgoing payments that the government need to make, things like Social Security, veterans payments, defence, Medicare, Medicaid, and of course its bond obligations. And if it doesn't have the funds to do that because they've been constrained by that debt limit, then it could create sizable volatility in the market. So really the debt limit was put in place to create checks and balances and make sure obviously the US doesn't be overly reckless in terms of its spending.
So we're in a period of negotiations in US politics. We're running out of funds to pay its obligations by early June. How confident are you that we can get an agreement before this loose deadline?
Not very. One, because the window for negotiations is so tight. If you look at the House and Senate recess calendar, there's I think like 7 days when they're both together. And if you include Biden, who has his own calendar as well, it's a very narrow window to negotiate. And the fact is the starting points are so wide at the moment. The Democrats are saying, and Biden is saying that we want to raise, of course they want to raise the debt ceiling. It makes a lot of sense ahead of an election next year. But they want to do it unconditionally. They want to have a clean debt ceiling negotiation. So they don't want anything attached to it, anything debt limit associated with any kind of fiscal measures attached to raising the debt ceiling. So they want a clean break. The Republicans, on the other hand, have a very different tactic. And certainly they want to have deep-rooted spending cuts and spending caps coming through. Of course they do, but the Republicans have been playing this game playing this line for a while. And so the starting points in terms of what they want to achieve are very wide indeed. And to get that togetherness, I think, is going to be very difficult before early June for sure.
Yeah, and there is this X date. Do you see a change in market volatility if we cross this date? How do you see the trading environment for clients changing if there is such a change?
Yeah, well, I mean, this is something that you would be talking to people at the moment about, this very low volatility. I mean, if you have a look at the daily chart of the dollar index, I mean, it's just going sideways with very, very low range. Yeah, we've got the VIX trading 16, 17%. We've got FX vol very, very low. So, yeah, I think, does it change? At the moment, no one's really prepared to put on any X dates or debt ceiling trades. At the moment, the moves are very confined to US Treasury bills that mature in June, which makes a lot of sense if you're a bond or a money market dealer or a bond dealer. You're not going to basically buy these bonds in case heightened risk that if you get default when you've got choice elsewhere. And so I think that you are seeing stress in the Treasury bill market. You're seeing signs in the credit default swap market, which are very, very illiquid. This is the cost to insure against US government default. You can use these credit default swaps, and they've moved up very, very sharply in the last few months. And people are saying this is a sign that people are protecting themselves. And actually, if you look at S&P volatility, if you look at skew, you can see that people are starting to pay up for put option volatility as a hedge there as well. But outside of those markets, in the markets that our clients trade, there isn't really any stress at all. I mean, people, and I think part of that is down to the fact that we're still too far away from the 1st of June. In our world, a day is a long time, let alone, a couple of weeks or so. So I think that time will come. Now, the issue is what we are looking at very closely is the daily cash balances that the Treasury put out to the public. At the moment, we've seen this around $185 billion, and it's coming down. It looks like it's falling away. And as we go into June, if we see that coming to about $50 billion US dollars or so, the issue for the market is in that first two weeks of the window, 2 weeks of June, we know that the US Treasury Department have about $80 to $100 billion of outgoing payments they need to make for Medicare and also for Social Security. So will they actually have the funds to do that? Now, we know that on the 15th of June, they receive a sizable $50 to $60 billion dollar inflow from corporate taxes. And at the end of the month, we also know that they're going to receive a significant inflow, about $140 billion from an investment which is maturing. So if they can get past the 15th of June, they should ride it out into July. But we know that there's a situation there. So the market is already showing stress in the bill market. The question is will we start seeing that flow on into volatility in the yen, the Swiss franc, gold? Are we going to see significant drawdown on banks, not because of deposit outflows, which has been the concern, but more because of people sensing the debt ceiling is going to be an issue, and we may see prioritisation in payments being cut back.
Yep. And speaking of volatility, there have been contrasts to 2011 and the volatility we saw there.
Yeah.
How do you see this as a guide or case study for where we are now?
It's probably the best one that we have to go for. I mean, 2013 was another one as well. And I think it's probably down to the mix of Congress. It's exactly the same. I mean, it's the different degrees of majorities in the House. They've got a much slimmer majority in the House this time around. But what we saw in 2011 was obviously we had Biden in the White House. We had a Democrat in the White House effectively. We'd just seen the Republicans take the House after the midterms, which is what we saw here. And we also know the Democrats control the Senate. So that congressional mix is exactly the same as what we're seeing here. I think where it differs is in economics. Relative economics are very, very different indeed. In 2011, they had a 9% unemployment rate. CPI, headline CPI in 2011 was at 3.6%. It's obviously, headlines at 4.9% and cores at 5.5%. So we've got much higher inflation, and therefore the tolerance for stimulating again is obviously different. But that would require, it would only stimulate obviously if we saw a massive tightening of financial conditions. And also, I think most importantly is that the Fed funds rate in 2011 was at 0.3%. It's at now at 5.25%. So which that means if we were to see markets come alive with volatility, and they say that this is going to cause stress to the financial system and therefore an impact on growth, then I think that the Fed will have to come out and cut rates quite aggressively. They have much more to work with in terms of the Fed funds rate. And therefore, I think, whilst we did see the US dollar sell off in 2011, specifically against the Swiss franc and against the Japanese yen, and gold prices had a really strong rally, I think that we could see a more pronounced move in the US dollar. I think that if we were to see a situation where the market thought that we could see a technical default, which we can touch on, then I think that would be even more pronounced in terms of the US dollar. But the fact is that economics are very different this time round. The Federal Reserve are going through quantitative tightening at the moment. And in 2011, they were raising their balance sheet by about 9% or so. So those dynamics are very different this time around, which means that in theory, you could get a much more pronounced move in the US dollar if the debt ceiling becomes a volatility event.
Yep. And you mentioned this technical bond default just before being a low possibility. But if the market senses a default is actually a possibility, how do you see this impacting markets around the globe? Very badly, which offers opportunity for CFD traders, obviously. We like volatility, but then there's also a sign when volatility becomes too high, and I think that becomes problematic in itself. So we just need to recognise the signs for volatility, and as you would know, speaking to clients all day, when you have high volatility, you need to look at your leverage, how much risk you're taking on position size and all those factors. But I don't think this is going to be a one-day affair. That's the great thing. If we were to see the market thinking that we were going to see a technical default, or what I prefer to call a deferred payment, because ultimately if you're due a coupon or you've got a T-bill which is maturing and you're not going to receive those proceeds, eventually you will be made right, because we will see a situation where the debt ceiling is raised eventually, and you will be made right in that situation. But in that point, it could get very, very messy indeed. We know that Fitch have already said that they will downgrade the credit rating of the US. We know that there's going to be other countries who will be looking at that and saying, do we want to draw down and lower the amount of dollars that we have as reserves? People will be looking at what happens with the yuan and those factors as well. But it just becomes very messy if you know that you're due to receive a maturing T-bill, but you're not going to get those proceeds. That has impact because T-bills are very much used as collateral for various parts of the financial system. So I just think
our job as traders is to manage risk, and if the visibility about managing risk on that, it would just be so low, and so therefore I think you'd see the dollar getting absolutely carted out. I think gold would rally significantly. People would buy treasuries, and I think the Japanese yen and the Swiss franc would do incredibly well in that situation as well. So look, I think it's a very low time. The credit default swap market is pricing that at 4 to 5%, so very low indeed. And we've also seen Biden saying, and this is important, that if we get to that point, it looks like he could change or look at the 14th Amendment, which means that he can go rogue effectively and actually raise the debt ceiling independently. The Republicans would obviously be very angry in that situation. There'd be a lot of legal challenges against that. I'm not sure they'd get very far. But Biden can pull out pocket aces effectively and say, we're just going to raise it independently. So we hope that doesn't happen. But if the market got a sense that we were going to see a bond default, then you would see significant volatility. What's more likely, though, Mitch, in the short term, is we're going to see this process of prioritisation and other payments being missed as opposed to the bond situation. Because what they're looking at is the capital that they do have. They'll want to make sure that bonds are good, that social security is not going to get missed, because that could have a significant impact on consumer spending and consumer sentiment. And so they'll look at prioritisation, things like defence, vets payments, Medicare, Medicaid, all these factors, and they'll look at a chain of where do we want this money? And I think that's what so there could be payments missed, and that could impact economics and growth. But I think the bond default is still a very low probability.
Yeah. And so you've mentioned the high probability of the debt ceiling being raised. So let's say that the debt ceiling is raised. Do you see this being outright positive for risk assets like equities, if at all?
In theory, it should be. Yeah, absolutely. I think depending on how much stress there is until we get to that point, if they raise this on the last day, in early June, I think the market will rejoice somewhat that we've got some certainty and we can move on past this point. Depending on what it looks like, are we going to see a short-term extension? Is it, or more appropriately, is it going to be past the election, maybe 2-3 years? And depending on how much stress we have in markets into that point, will determine probably the snapback in the rally. I think what happens after that point becomes also very interesting. So let's say they raise the debt ceiling for 2 years. Eventually, that will happen. Then I think we go to a point where the Treasury Department will be able to issue $900 billion to $1 trillion worth of short-term debt. Now, what that means is that they'll be able to use that and replenish the Treasury General account. So what you'll see is the TGA rising, and effectively someone will be asked to buy those T-bills, and that will be sucking liquidity out of other parts of the market. Of course, that's going to be the private sector. So that liquidity drainage could be a negative for risk assets. And I think it will take a lot of dollars out of the system. So I think once we start to see a big rebuild of the what they call the TGA, the Treasury General account, as they start issuing a lot more of that debt, then I think that could be actually a very good buying point for the US dollar. I think the US dollar in that point could have a significant rally.
Yep. All right, Chris, thank you for that. Always a pleasure having your insights into those and tapping into your mind. So as you can see, the debt ceiling topic is vastly complicated and holds the potential to trigger volatility moving forward, as we've heard. We hope this has provided you with meaningful insights, of course. And if you have any questions moving forward, always feel free to contact myself and the team, including Westy. Thank you.
Thank you.